Sorry, go ahead.
I was going to say, I have 12 p.m. I think it's a good time to get started. Good afternoon, and thanks for everyone for joining us today for session 8 in the Refocus and Rebuild webinar series. This series is focused on helping Virginia businesses reopen in a COVID world. My name is Sandy Ratliff. I'm with Virginia Community Capital. If you're not familiar with us, we are a community development financial institution in Virginia that provides lending, investing, and community innovation services. We are happy to partner with the Virginia Small Business Development Center Network, GenEdge, University of Virginia's College at Wise, and the Southwest Virginia Alliance for Manufacturing to present this weekly webinar series. This is a 13-week series, and I hope that you have been attending the first 7 and plan to attend the remainder over the next few weeks through October the 29th. We have a great lineup of speakers and topics that can help you. And hopefully what we will do at the end is you're going to be able to develop a resiliency plan for your business should another disaster or pandemic hit. If you noticed in your reminders, you should have received a link with a variety of templates that you can access in regards to developing your own resiliency plan for your business. And I hope that you will, that you've been using that and you will continue to use that over the coming weeks. Before we get started and I turn the session over to my co-host, we do have this session muted for everyone just so we can keep in with the 1-hour time frame. However, if you do have a question for our presenters or any of the partners, we ask that you will post those in the Q&A section, and those will be addressed at the end of the presentation. I'm happy now to turn over the program to my co-host, Lenny Gale Mitchum with the Southwest Virginia Alliance for Manufacturing, who will introduce our presenter and take over the webinar. Lenny Gale, it's all yours.
All right. Hello, my name is Lenny Gale Mitchum. I am very happy to be here with you all today, and we want to thank our presenter, John Martin, for being willing to do this and provide this information for us. John Martin is a shareholder with the law firm Penn Stewart. He practices areas in workers' compensation and employment defense, as well as small business development. So thank you so much, John, for being here. We're excited to hear from you, and with that, I'll turn it over to you.
Thank you, Lenny Gale. I'm always happy to work with SFAM and the small business.
Uh-oh, John, we lost you for a second.
Lenny Gale, can I jump back on while he's coming on, and I'll make an announcement to everybody?
Yep.
I would just let everybody know that the Rebuild Virginia grant did expand its requirements and eligibility on this past Monday, and the SBDCs are working with clients that are interested in that. You will find that there are expanded business categories. In the first round, if you received any type of CARES funding, you were ineligible to apply for this grant. The grants do go up to a possible $10,000. That is through the CARES money that came into the state of Virginia. So if you are interested in that, please contact one of your SBDCs and they will be happy to assist you with that.
All right, thank you, Cindy. John, do we have you back?
Well, I think I'm still having bandwidth problems, so I put the outline on the screen. Can you see that?
We can.
Okay, and I think probably just to avoid what seemed like a bandwidth issue on my part, I'll keep the screen blackened, if that's okay. Is that all right?
Mhm.
Okay. As I started to say, I am by no means an expert or even somebody with significant experience in an ESOP. My focus and my attention when Lenny Gale was kind enough to offer the invitation for me to speak about this, my interest was immediately on the aspect of small business development and more importantly under ERISA and employee benefits. I found some increasing practice areas in that of late, and so ESOPs fall within ERISA planning. They're pretty fascinating. The flexibility that they provide to an employer, quite amazing if you sit down with someone and consider your tax strategies, your long-term planning strategies, and the possibility of rewarding employees who more than likely are not in a position to outright buy shares from a retiring manager. ESOPs really do offer quite a bit of opportunity. In most variety of the drafting purposes. So this is not a very deep conversation about ESOPs, but I hope it gives you the understanding with the outline and the information there. I hope it gives you the understanding to know that it's a possibility that a small business owner may have in the future for a variety of things. So with that kind of understanding, let me go ahead and start. When you look at the definition of an ESOP, it's governed by a couple of different laws. But the bottom line is that it's a stock ownership plan that is designed to provide benefits to the employees. That's the ultimate benefit. Now, as we see, we'll talk about it as we go along, there are a variety of other benefits that are included that naturally come along. And I think in more recent years, ESOPs have become the focus of flexible corporate financing. But legally speaking, an ESOP, and we're right here at number 2, an ESOP is just a trust fund, but it's a trust fund imbued with certain tax categories that are beneficial to both the employer and the employee. But as with any trust fund, it's set up for the benefit of a beneficiary. So a trust fund typically, even under the owned by somebody on the legal end, but owned by somebody else on the beneficial end. So that's the same with an ESOP. That's how they work, and that's how they initially start. As I mentioned, an ESOP is a benefit plan like a 401k or a simple IRA that an employer may set up. And for particular tax qualifications,
John, we seem to have completely lost you there.
that world or whether
John.
I'm freezing.
John, we
Yes.
lost you there for quite a bit.
Oh, I'm so sorry. I keep seeing the Cisco light blink, Lenny Gale, and I'm not sure how best to address that.
Maybe he mentioned you want to use cell service audio?
Yeah, I was gonna, would it be better to call in or to try to, let me see if I can jump to the phone hotspot because sometimes that's a little better.
Okay.
Bear with me, and I'm so sorry, folks.
While John is doing that, do we have any other announcements from our panelists? And if anybody wants to take this time to enter any Q&A any questions, Q&A, enter any questions that you may have for John that we can get to, please do so.
Lydia Gale, is that better?
We hear you.
Okay, let's give that a try. Sometimes the phone cellular is better than the Wi-Fi, so I'm going to see if that'll work.
Okay.
Where did I fall off the internet world?
I'm not exactly sure. You were gone for probably about 30 seconds or so.
Okay. Let me, did it break up again?
Oh, you're good.
Okay. So let me start with section D on the outline. And as I was telling you, an ESOP comes under the regulations for ERISA. Those are the Employee Retirement Income Security Act of 1974. And if you're in the investment world, you're probably painfully familiar with ERISA regulations, because those are the regulations that address retirement plans such as 401ks, simple plans, like I said. And they're fairly draconian because the Department of Labor regulates ERISA plans. So in this situation, both the Department of Labor and the Internal Revenue Service regulate ESOPs. And that means that you're subject to an audit by both. And our good friend Mike Spiegler once told us in a seminar that everybody fears an IRS audit, but a DOL audit makes that look like a walk in the park. And there are different rules and requirements, hours, and for instance, the Department of Labor focuses heavily on the hours worked by people to determine whether or not they qualify for certain benefits. So just keep that in mind, that there are the incumbent fiduciary duties that go with any ERISA plan that would accompany an ESOP. And what I'm really leading to with that is, while there's tremendous benefit to both the employees who would become shareholders in the company and employers who would somehow finance the sale of their own shares, an ESOP, like any other retirement type plan, has a lot of administrative costs that can go with it. And I'm sorry, folks, my dogs are joining us, so you may hear a little extra noise. Under Section E, an ESOP is typically formed in conjunction with succession planning. And when we say that, the mechanics of it make it such that typically small, single, or just a few member owners and companies can take advantage of an ESOP by establishing the ESOP. That becomes a ready buyer for the shares that they hold. So that is one of the very strongest benefits right now to ESOPs. And as I noted, that a lot of times the ESOP becomes the buyer of stock, and usually ESOPs are formed in conjunction with analysis for the company. Somebody looks at the situation, and when you have small, closely held companies, and you're probably all familiar, you just don't have a buyer on the street. So it's one of those situations where usually, typically in conjunction with the purchase or the sales analysis of a company, an ESOP that's when you begin to discuss the possibility. And Section F, as I noted, companies often use, earlier I mentioned, companies can often use ESOPs for finance purposes. And when that occurs, the benefit there comes from the fact that the company, the small company, and I'm thinking, 2 or 3 shareholders in a company, usually founded by somebody who's senior in both experience and age, and they find themselves at the point in the career where they want to get out of the company. They want to begin to get rid of their company. And an ESOP provides a situation where the ESOP itself can become the purchaser, it can become the borrower, and it can be the source to establish a market for stock that may not otherwise be available to the owner of the company. In many instances, the creation of the ESOP works as a means to obtain the financing that otherwise wouldn't be out there. In doing the research for this, there are several banks and lending institutions that focus on ESOP lending. It typically provides a source of revenue. There's a little bit of a premium with regard to the interest that might be on the loan, but they understand the acquisition rights and they understand how ESOPs are formed. So there is a market out there, and it's a small market, but for those who know how to do this and for those who work with ESOPs on a regular basis, there is a ready-made set of supporters. When you come down and looking at section G, this is one of the pieces of the discussion that I think are most important. The ESOP typically comes into creation. Once the trust fund is established, and once the Internal Revenue Code application and approval takes place, then the next step is the critical piece, and that's the funding of the ESOP with stock. Under Section G, right, and I indicate that the ESOP has the opportunity to receive new stock from the company. The company, if it truly wants to leverage ESOP stock for other benefits besides just a retirement or a succession plan, the company can create stock. It can put that into the ESOP and have that new capital that comes into the company as something that it can use for investment purposes. That's a unique situation. It doesn't seem to be as discussed as much in the literature that you read about this, but that is one of the pieces that's out there. So, a company that needs, it's a $10 million company and they need a $2 million line of capital, that's one possibility that they can do is issue new stock, go ahead and acquire the loan, and utilize the tax benefits that come with that. Other ways that stock goes into the ESOP, the traditional situation where a senior shareholder decides to sell their shares, and ESOP, the ESOP itself becomes the buyer of those shares. So those are just a couple of ways. And I'll talk about those in a little more depth just as we go along. The rules for ESOPs allow both S corporations and C corporations to set up and administer an ESOP. So depending upon your tax scheme and how the company is set up, an ESOP is available for use for both C and S corporations. There are limitations that are different for each company. And in some situations, I've read that shifting your S election for tax purposes, may be preferable, even though there are tax consequences at that time. And by no means anybody who would advise you on tax scenarios, but just bear in mind that those are available options that make an ESOP incredibly flexible. The mechanics of the ESOPs, I thought they're fairly straightforward. It's the tax ramifications and the amount of money that can move back and forth that seems to be where more of the consideration is. But as I noted, we talked about once the company sets up the trust fund and the company applies for Internal Revenue Code or Internal Revenue Service Esop qualifications, you basically have the shell of the ESOP. Then the IRS has its own set of requirements, as I noted. The biggest aspect at this point, though, once you have once an employer has made the decision, after all of the analysis that's necessary, once the decision is made to establish an ESOP, both the IRS and the Department of Labor require that the employer obtain a fair market valuation of the company. So it can't be a situation where the employer decides that, hey, my company is worth $30 million and I want to put 50% of my stock into the company at a value of 15. So this becomes one of the administrative requirements that can be quite costly with an ESOP. All of the literature that I've read suggests that the ESOP establishing an ESOP is typically cheaper than going through the purchase and the due diligence process of going out to a third-party vendor. A couple of the reasons that one of the particular companies that I read, or one of the particular websites that I read, discussed why that is, and I thought it was kind of fascinating. Apparently, 30% of all third-party transactions for a closely held company actually take place. The number of default purchases is well above 50%. And the reason being, it's just when you go to a car dealer, you understand what you're buying. You're buying a Nissan, or you're buying a Ford, or you're buying a Chevy. But when you're trying to sell a machine shop, for instance, that's been in a family for 30 years, that's a unique creation, and it's not going to be operated in the same manner as the machine shop 10 miles up the road. And so what happens in so many instances is that you go out, typically a broker is utilized to go out and find a buyer, and the instance of the transactions not completing is so high that it adds to the cost. So I don't know if it's a dollar for dollar if you're successful. I don't know if establishing an ESOP is dollar for dollar cheaper, but I think in statistics and statistical terms, establishing an ESOP, even with the administrative cost, is still a little cheaper. Interesting little trivia. As I noted, the valuation of the stock has to happen. If a company has reached that point where they're really truly moving forward with an ESOP, then usually what happens, despite the evaluation of the evaluation of the stock and the company decision to establish so much percentage in the ESOP, usually as a precaution for treating now you're talking about a trust that's established for the benefit of your employees. So even though it's your trust as part of your company, you have to begin to think about it in terms of an employee benefit plan, and you have to start to deal in terms of fair market dealings. One of the common scenarios here is that there are vendors who provide third-party trustee services on a temporary basis. So they will take a look for hire, and they will determine whether or not they agree with the valuation of the company, and then they will set a price to determine how much the stock is actually worth that's being transferred to the ESOP. So at this point, it becomes more of a arm's length transaction where somebody else comes in and starts to act on the benefit of the employees. So that $10 million company decides they want to put 30% of their shares into the ESOP. They feel like the valuation of the company is a little low at $10 million. The trustees may take a look at this and say, or the temporary trustees may take a look at this and say, yeah, we want $3 million of the stock, but we really don't think it's worth $3 million. We want to call that a lower number. So that's one of the aspects that kind of becomes a difficulty with an ESOP. But by the time you've made that decision, by the time you're at that decision, you're well underway into establishing the ESOP. The next aspect is again, I think this becomes a little more commonsensical, and it sort of makes more sense to me anyway. Once you decide that you're going to move forward and you've established your price on the stock, then the question is, how do you shift stock from the owners of the company into the ESOP? And there are four basic ways. There are other ways as well, given the flexibility of the company. But the four basic ways. The first is the company issues new shares, just like we talked a minute ago. That's typically a situation where your managers are going to stay in place, and they decide that they're going to issue new shares for capital gains or to raise capital. And the second scenario is the one that is most common. The company contributes stock to the ESOP, which is then used, the company contributes cash to the ESOP, which is then used to turn around and buy stock from the managers. And that is by far and away, from what I understand from reading, that is by far and away the most common methodology. So you have a company, cash flow is appropriate, the stocks are valued, and the decision is made to put so much stock in the company's, so much of the owner stock into the ESOP. So 20% in our $10 million company model. In this case, the company would basically provide the money to the ESOP and start to begin to buy that stock. And they may not buy 20% at this time. They may buy 10%. But that has to be made in conjunction with the distribution that we'll talk about a little bit later. So the benefit at this point is, once that cash contribution is made to the ESOP, that the company makes that, the employees do not make that contribution at all. Once that happens, the company begins to qualify for tax deductions on the money spent. If you go into section small c there, third, the ESOP can borrow money. And that's also very, very common, because that's a situation where you may commonly see that in conjunction with an employer, manager, stockholder trying to begin to establish their exit plan. So in that situation, they don't want to take money from the company revenue, but they want to begin to get rid of their stock, and they want to begin to find somebody to buy that stock. So they'll establish a situation where they, in conjunction with the trustees, will direct the ESOP to borrow money. The return on that aspect is that the company makes the payments to pay down the note. So reverse B and C, the money in B is paid up front, the money in C is paid over time. But in either event, the company is still making the payments, and the company is still providing benefit to the employees. And lastly, sometimes you'll see ESOP situations where the manager, the shareholder of the company, takes a note for stock that they have contributed to the ESOP. So the company begins, instead of paying the banks back, the company pays the manager over time. And that's typically done in a very closely held company and it can also be done in conjunction with borrowing money from a bank or traditional lending institution. So maybe 10% of the stock is paid for by a note from the bank, and another 10% is paid for by a note from the employer. As I point out, regardless of how the stock is acquired, the company contributions to the ESOP are typically tax deductible when done appropriately. There are certain limits. I think there's a 25% mark, 25% of the actual payroll of the company. Actually, I'll leave that for a tax specialist, but there are limitations on how much in a given year can be paid out. The 25% mark is in the equivalent to a 15% mark for 401k contributions, for instance. So in that case, if cash is used to purchase stock, then the cash, the value of that cash is deductible to the company. if stock is placed, if new stock is generated and placed in the company, that valuation that we saw in the beginning of the process, that stock then is valued and it's placed into, that's then the number that can be used for tax deductions. So either way, that's the most immediately attractive piece for regarding an ESOP is this tax scheme. For those of you who are more familiar with lending institutions and taxes with regard, in a typical situation, a business cannot deduct the amount of the loan that's being paid back, only the interest on the loan. The laws and the regulations regarding an ESOP allow the entire amount of the loan to be considered a tax deductible contribution on the part of the employer. So anyone that is doing their tax planning, that's one major benefit that an ESOP provides immediately, is that loan becomes a fully deductible feature for the company's taxes. Briefly, I've mentioned that those two types of ESOPs are considered differently. There's the unleveraged ESOP and then the leveraged ESOP. And most of the ESOPs, there are several different companies that exist that are dedicated towards understanding and promoting ESOPs, and they keep statistics on these things. And the unleveraged ESOP is by far and away the lesser of those two. And Lenny Gale, if I run over time, you shoot me down very quickly, please.
No, you're doing well. We're here until 1.
Okay. So we'll jump on down to D, because I think that's the piece that's very, very interesting to most of us. How does the stock become of benefit to an employee? And there's several different factors that go into that, but for the most part, as I mentioned in the beginning, because the ESOP is technically an ERISA plan, then the company at the outset will subscribe to a plan that addresses the various aspects of stock ownership, the various aspects of your benefits. The IRS requires that an employee over the age of 21 be allowed to participate in an ESOP if they're employed full time. And the plan typically sets out the definitions for things that are such as a full time, and that may mean 1,000 hours worked in a year, or whatever the company may desire to make an employee qualified to receive ESOP benefits. But basically, the plan then sets out the specifics. The law requires also that anybody involved in the plan has to be able to vest 100% in their benefits over a 6-year period. And some companies do that in 6 equal increments. Some companies, I've read a couple of plans out there that provide 10% for the first year, another 20%, et cetera, et cetera. So it's really whatever scheme that company and their plan draft or put into place. But ultimately what happens is once you become vested in the benefits, then you're entitled to take those benefits with all the tax consequences that come with that. And if you think about it, it's like the company is buying stock for you in say Apple or, Google or whatever company would want, but they're holding that stock for you. Once you vest, then you're entitled to the benefit of that stock. Now, that's the important piece. Despite the fact that you may be fully vested and you may have 20 years in a company with an ESOP, you never really get to hold that stock. But the company has to treat that stock as if it belongs to you And at the point in time when you decide to leave the company by retirement, there's several different factors that allow you to take the benefit of that stock. Again, the plan will specify so much of that, but one typical formula is that as you approach age 55, you can begin to relinquish your interest in shares in exchange for a conversion to cash, which then gives you a certain amount of time to reinvest that in other qualifying tax deferral products. You could go out and purchase your own or roll it over into your own IRA. Those are just a couple of the ways that happens. The plan usually provides that once vested, the company must pay you. I'm getting ahead of myself. Once vested, then you get the full benefit of your portion of the stock in the ESOP under a couple of scenarios. One, you leave the company. Two, you retire. Or three, as I mentioned, you convert the stock and you begin to wind down your account. If you leave the company after you've been vested, the plan will dictate how long the company has to hold the money in their hands until they pay you out. So again, the plan, like any other employee benefit, is extremely important. If you're a member of an ESOP or have someone who is a member of an ESOP, there's a plan administrator. You can write the plan administrator and request a copy of the plan at any time, and that will tell you how that stock becomes of benefit to you personally. One area I didn't write anything about or put anything down is, typically if there's a sale of the company, say 30% of this company stock has been placed into an ESOP trust fund, that money still remains for the benefit of the employees, assuming they're vested. And typically when the stock in the company is sold, the ESOP is terminated or it's wound down, and at that point, then the employees who are vested in the ESOP have the opportunity to take the money and move that into a qualifying account. I'm sorry, I'm off script a little bit, but the big thing to remember is that stock transferred to the ESOP remains unavailable to the employee in terms of being able to go out and sell it. The link for the employee to the benefit in the stock is the existence of their employment. The big thing too, one of the qualifying pieces is that stock delivered to the ESOP or cash delivered to purchase stock for the ESOP is made by the employer without contribution by an employee. In other countries, ESOP means a different thing. It's a stock option plan. And that's where the employee actually puts money down to purchase stock or an option on the stock. So the American form of ESOP is very different than other countries. One of the other features that would be identified is Section 5 here, highlighted. Those factors are determined in the plan. IRS rules require that you cannot, like with other employee benefit plans, you cannot overly compensate a highly compensated employee from the outset. So you can't take the manager of the company or the vice president of the company and pay them 5 times the benefit that they might get. There are limitations on that. The most common formula that goes along with establishing benefit for employees in an ESOP is tied to their compensation. So, typical management folks may be at a higher salary level proportionate to the entire payroll pool. They're allowed to get that much more benefit in the stock than others based on the proportionality, but they can't be overly compensated, if that makes sense. There are other methods by which employees can receive or be attributed benefit in the shares, but typically so much of it is tied to a compensation model. One of the other benefits to the ESOP, the longer there, once you've vested, you continue to get, continue to gain access and be given the benefit of additional stock. As you go along, your seniority increases, your benefits in the ESOP increase, and your wealth in the ESOP increases. There's a theory, and I think when the ESOP was originally conceived, it was conceived with the idea that this is a way to bring employees into the fold, so to speak. I think it's become more of a financial methodology of late, but there is a lot of discussion about creating an ESOP and whether or not that improves morale in the company. From everything I've read and what I understand is that can be a very, very beneficial side effect, but the employees have to begin to understand that their benefits are accruing and that they truly do have these benefits. Because there's no actual cash transfer, there's no money exchange in the beginning. As with a lot of retirement-oriented planning, the employee doesn't receive a financial benefit on a day-to-day basis. And so sometimes that financial benefit may not feel as real as it would if it were some other type of remuneration. So the emphasis on whether employees' morale improves seems to be up for debate. Bear with me just a second. Under section 10, one of the benefits that the ESOP should provide to the employee is that once they do take that, once they are able to convert their interest into cash, there is a certain period of time under the IRS that money can be converted to other tax deferred schemes. And so that money isn't immediately taxable. You've got a certain amount of time to turn that over. So there is a tax deferral scheme that goes with that. If you're a member of an ESOP or have some interest in that, then that is certainly one thing you would want to check with the plan administrator before addressing those kinds of decisions to take that money. The other thing, there are smaller pieces that go with it. The employees in an ESOP act as a collective. So the ESOP may own 20% of the company stock. The employees then are given their pro rata earnings or benefits in that ESOP trust fund, but collectively they can vote their 20%. So the law requires that the ESOP trust fund be allowed to vote on major issues. So what constitutes a major issue is defined in the code and the regulations. One of the major issues that is specifically always referenced is the fact that if the company decides to move, if the question of moving the company is on the table, the ESOP gets a chance to vote. But when you're talking about smaller day-to-day decisions, both the Department of Labor and the Internal Revenue Service allow the ESOP trust fund votes to be deferred or handed over to the board of directors of the company, for instance, or the ESOP trust committee. So there are other ways. So just because they do have the benefit of a significant amount of stock doesn't mean they're always voting. Under employer administration of the ESOP, as I mentioned, establishing an ESOP can be kind of costly. Administration on an annual basis can also have some cost effects or cost, but typically they're in line with other employee retirement plans. Remember, we talked about that you have to have a company valuation to establish the ESOP, so that the ESOP trust knows what it's getting. Thereafter, in order to continue receiving tax benefits, tax breaks, the company has to provide an annual valuation. They're typically not the same, but they do check to make sure that the company hasn't tanked, or that the market that the company is in hasn't so drastically changed that it would affect in one way or another the value of the company. The company is also required to provide the employees and the members of the ESOP with notification of what that valuation is. So the company is supposed to provide a fair market value to the employees of their stock and their portion of the stock on an annual basis. As I mentioned, the ultimate objective in establishing that trust is that the employees are the ones who receive the benefits of the trust. So if you do run into a situation where a company management, the worst case scenario would be where the board of directors in a small company doesn't realize that somebody has embezzled money from the company or something along those lines. The company would have its own liability. The employee that embezzled the money would be liable. But in addition to that, the board of directors and the trustees of the ESOP could very well be liable to the ESOP because of the diminution in value that occurred by virtue of the board being asleep at the wheel, so to speak, and what it did to the ESOP's value. So those are all new pieces and parts, and they become quite different than the situation where, Mr. and Mrs. Smith started a company 25 years ago and they've held 100% up until 5 years ago when they decided to create an ESOP. They are truly bringing other people into the fold, and the law requires and puts various obligations upon them. Benefits, I've talked about some of those. It's hard to talk about it without really addressing, but I'll talk about this because of the timing. I'll even skip down and kind of try to weave this into the discussion. When Linda Gale mentioned it to me, one of the things that was discussed is how do you use an ESOP in succession planning? What goes on there? I alluded to the fact that in the beginning, a closely held company isn't always something that you can just go right out and buy off the shelf. You have to marry up a buyer with the seller, and they have to have like interest. An ESOP can be involved or can be utilized by a company. Going back to Mr. and Mrs. Smith and their 25-year company worth $10 million. A lot of times these entrepreneurs, and they have created these companies by the sweat of their brow, and so they have lived. The company has suddenly turned to the point where they're fairly affluent. Their efforts have paid off, and now they're starting to see the benefits of their company, but they don't have those benefits in a cash factor. So many of the articles that I read and I looked at, they talked about why you would use an ESOP instead of go and sell to a third party. There are deferred tax consequences. Again, like I said, they can be complicated, but the bottom line is if an employer takes a note on the stock that they put in, then they don't realize, Mr. and Mrs. Smith want to eventually sell 100% of their company. They can do that over 5 years or 10 years, and they can take that money without the immediate tax consequences, the higher tax bracket. So that's one aspect. But again, when you talk about a closely held corporation, and I understand that large C corporations can use ESOPs, but I think, in our area, we would be talking about a smaller, more intimate type of company. You get into a situation where it's hard for Mr. and Mrs. Smith to give up control. They've done this day in, day out for, all these years, and they just don't want to stop. If they sell to a third party, two things typically happen. One, they're kept on board as a consultant for a certain period of time, and they may or may not have an active role. Consultant may just be somebody there to call once in a while when something goes off the rails. The consultant may be somebody who goes around and observes everything to make sure that it stays on par. But their role changes; they're no longer in management. They become the new company takes over. Then, additionally, when you sell to a third party, typically in a situation like that, where the company is unique and it's created over time with love and care, so to speak. One of the things that happens in almost every transaction is that Mr. and Mrs. Smith are asked to sign a non-compete. And so if they do that, maybe they want to do a smaller version or something similar, or they want to do an offshoot of the work they've been doing. The non-compete typically can keep them from being able to do any of that anywhere near the location of their company for a number of years. So an ESOP can allow them to put their stock into the company trust, to back out. It also allows them to work with the new management. So they have a younger, maybe it's their children, and they don't want to give the stock to the children for tax consequences. But the children are managers, and they're going to receive benefit from the ESOP as well. So there are a variety of ways and methods that an ESOP can benefit an employer who's interested in succession planning. There are also ways that the company stock can basically be held in the name of the ESOP, allowing Mr. and Mrs. Smith to take, say, 30% or 60% of the value of their company while still being involved in the company. It's just that they are not the true owners anymore because they've essentially cashed out their funds, but they still have a role. They can even still maintain their participation in the company, making it much easier to get out. So, the possibilities are very, very endless. And the idea is that basically an ESOP gives the former shareholder considerable control over how the company continues. One of the most important pieces when you do any research on this aspect is that the ESOP, while I mentioned that there's an idea, the ESOP motivates employees who become shareholders. That's up in the air as to how effective that is. But one of the other aspects, when Mr. and Mrs. Smith decide to put their shares into an ESOP and to continue to be participating in the company, it may mean that their employees that they have worked with all these years continue to keep their job, because as we all know, when a company gets purchased, one of the most tragic aspects of it is that there are layoffs that come along for price valuation. So in any event, those are just a couple of ideas about an ESOP. I would submit to anybody, if they're interested in an ESOP or they have some ideas, there are specialists out there. The first place to begin is evaluation, or not evaluation, excuse me, but an analysis as to whether or not the ESOP provides you with the goals you want. In any event, I've listed that, and as I close with, there are serious tax consequences, and you really, I think they're extremely flexible, extremely valuable employee benefit plans, but they do require considerable analysis from the outset before you even get to the point of establishing a trust. But anyway, I'm just about talked out, Lenny Gale. I don't know if that helps anybody or if I've bored anybody to death.
No, I think you did a great job. Oh, I'm echoing. So we have one question I see here in the chat. What size company would benefit from an ESOP? Would an ESOP be beneficial to a small mom and pop business that wanted to transfer the ownership of the business to their children/heirs working in the business?
Yeah, I've read quite a bit. I've read a lot even before Lenny Gale and I talked about this, because a couple of companies that I've worked with have had succession planning considerations. Now, one thing to remember that it has to be a stock corporation. It can't be an LLC, or at least I've not found any way that an ESOP can be an LLC. So, when you come to me as a small business development person, one of the first things that I'll tell you is let's talk to your accountant and see what you need to be in. Is it an LLC or a stock corporation? But you can make those conversions and they can sometimes be costly. So going back to the idea of a mom and pop, once we decide that we have stock and we have a number of shares, the question is, what do mom and pop, Mr. and Mrs. Smith, want to do? Do they want to, sell out, hang it up and go to Florida? Or do they want to work 4 months a year when they're in town, when the race crowd isn't around and they want to be participating in what they're doing? All of those are very, very personal decisions. And they're also something, and this is what I always appreciate the most about small business development. These are folks that have really worked hard. And in many instances, they become folks who no longer have hobbies or habits or things that they do because their company requires so much of them. That's the first place you have to look, is ask, what do you want to do? I mean, do you want to be, hands-on and less pressure, or do you want to, get out of it altogether? But assuming they want to be still involved and they have children that they want to begin to bring into the fold, an ESOP works wonderfully in that capacity because you can use the ESOP as a receiver for certain portions of your stock, and you can get that money up front. Then you can utilize the combination of the two to begin to transfer certain other aspects or certain other shares of your company into the hands of your children. So one of the things to remember, and one of the best articles that I read talked about the scenario of the company that wants to, they want to designate a junior member of management as the future company majority owner. How do they do that? They, typically the junior member doesn't have cash on hand to purchase the full 100% of the shares. If they do, typically the company makes it available for them by helping with bonuses and other types of benefits. If that happens, you have significant tax consequences. Let's say you have a junior member of management who makes $75,000 a year, but they're going to need to pay $100,000 a year for X number of years in stock, and they start to take on $175,000 in compensation, $100,000 of which is earmarked for repayment. There are tax consequences there that an ESOP avoids. So you can blend the two together. You can use an ESOP to give the proportionate shareholder or the proportionate employees, strike that. You can use the ESOP to give stock proportionate to compensation for employees. So in that situation, you've got that junior member of management who's higher paid. They're going to get a higher portion of the ESOP as that goes along. So you can merge those, you can manage those two together. So much of it at that point is a tax consequence, but that tax deduction portion attributed to establishing stock in the ESOP trust fund is the most amazing piece of this, because that gives you just incredible flexibility. So an ESOP can be, and typically I would think, be extremely useful for the small business companies that I know that I deal with. We would have some conversions for some of my clients to traditional stock companies, but I think the ESOP is a very good opportunity for those companies.
Okay. Awesome. Thank you. I'm not seeing any other questions popping up. Do any of our panelists have any questions before we let John go? All right. Not seeing any there either. So thank you so much, John, for taking the time.
You're welcome.
To share this information with us, and you will send this to me, right? And I'll
Yes, ma'am. Absolutely. Assuming my internet works again. I'm so sorry about that, folks.
That's okay. We made it through. We got it there. So thank you so much. Thank you to those that are partnering on these webinars. Thank you for all your hard work, Sandy. And thank you to everyone who joined us. And this has been recorded and will be shared along with the handout. So that's all we have.
Okay.
Thank you all so much for joining us. Thank you, John.
Yes, ma'am. Thank you all. Appreciate it. Appreciate the opportunity.
Absolutely. All right, everybody take care. Thank you.